Welcome to the Explainer. Today, we're going to totally change how you look at a price chart. We're unpacking a really fascinating case study from inter-equity trading to figure out how to find those absolute perfect entry points in the market. We're talking about sniper entries. You know, those incredibly precise moments where you get in right as the market reverses in your favor. So buckle up, because what we're going over today is going to clear up a massive amount of trading confusion. So I really want you to think about this for a second. Why is it that the absolute cleanest charts actually catch the biggest trades? I mean, we've all seen those crazy setups, right? The ones with 5 different indicators flashing all at once, just creating this massive chaotic mess on the screen. But by the time we finish up here, you'll see exactly why having just 2 simple lines on your chart literally destroys a screen full of messy indicators. We are going to strip away all that noise and just focus on what the market is actually telling us. All right, so here's our game plan for today. We'll start with the trader's trap, then move into framing the time frames, internal versus external liquidity, surviving market noise, and we'll wrap it all up with the sniper entry. Okay, let's jump right into section 1, the trader's trap, getting caught in the market's noise. Listen, if you've ever been chopped up in the market, you know the feeling, right? You enter a position, price instantly reverses, stops you out, and then it goes exactly where you originally thought it would. Well, you've probably fallen victim to inducement. And let me tell you, this isn't just bad luck. The market is actively engineered to trick retail traders. In this case study, they start by looking at a 4-hour chart and spot this massive, super aggressive, bullish move to the upside. Now, to the average trader, this just screams buy because, hey, the trend is up. But this move was explicitly designed to induce or tempt buyers into the market, leaving some really vulnerable lows behind. Once those buyers are in, the market fails to break higher, sells back off, and completely traps them. And what's wild is how precise we can actually be when identifying where these traps happen by using what's called a liquidity block. Picture a chart where price drops down, spikes out a previous low on the left to trap those induced buyers, and then immediately rips in the other direction. If you just draw a box around that specific area where the low was swept, boom, you've got a perfectly measurable liquidity block. It's basically a footprint left behind by market makers showing us exactly where traders just got caught off guard. Moving on to section 2, framing the timeframes and building that top-down narrative. So, to actually execute this strategy, you can't just dive headfirst into a 1-minute chart. You've got to build a narrative first. The absolute golden rule here is following these strict steps without any exceptions. Step 1, always start on the higher time frame, like the 4-hour chart. Step 2, pinpoint those specific areas where buyers or sellers got trapped, just like we talked about with inducement and liquidity blocks. Then, step 3, only then do you plot your liquidity lines for the lower time frames. And here's the harsh truth of it all. If you check that higher time frame and you don't see anything relevant, no clear traps, no obvious liquidity, you shouldn't even be opening your lower time frames, period. Now, as you're digging into these higher timeframes and actually executing trades, where you trade really matters. The source of our explainer today works closely with the Alpha Prime ecosystem, which honestly provides some pretty great routes for serious traders. If you're someone who strictly trades CFDs, Alpha Capital is tailored right to your flow. But on the flip side, if futures are more your thing, Alpha Futures is built specifically for that execution style. Having that right environment just ensures that when you do spot these traps, your execution is totally seamless. All right, section 3, internal versus external liquidity. Knowing exactly where price will run. So, once we know where traders are trapped, we have to hunt for really specific logical reasons why price would want to reach a certain level. Like we need to find its targets. If you're looking for a target for a long position, you need evidence. Are you targeting tapped imbalances? Is there a super obvious, almost too perfect trend line that retail traders are hiding their stops behind? Is there a cluster of seller liquidity just resting above previous highs? Or hey, are we nearing all-time highs? When you spot a whole cluster of these factors lining up, a move to sweep that external liquidity is incredibly probable. And this brilliantly illustrates just how insanely simple your chart marking should be. You really don't need complex algorithms. The market literally speaks to you through its structure. Think about it. If a high pushes up, respects a previous high to its left, and then just aggressively sells off, the market has just clearly communicated a liquidity level to you. It left those highs completely intact, which builds up orders right above them. So all you have to do is listen to the market and plot a single horizontal line right there. That's it. By plotting a line at your internal lows and another at your external highs, you essentially box price in. Whenever price is just bouncing around between these two lines, That's ranging, choppy action. Honestly, everything trapped in the middle is just dangerous market noise. We only care when the trending price action actively breaks out and sweeps those specific liquidity lines we just drew. Which brings us to Section 4, Surviving Market Noise, the psychology of waiting for the setup. Let's dive into a real case study, starting on a Thursday morning at 10 a.m. The market sets up this beautiful internal liquidity on the lower timeframes, but then it completely ignores it and just goes on a massive run. Now, during a live session, this confuses so many traders, but here's the vital mindset shift you need. If you correctly identify internal liquidity and price moves away without sweeping it, you didn't make a mistake. Yeah, that liquidity just didn't get used today, but you absolutely must leave that line plotted on your chart. Leaving a lower timeframe low untouched on a Thursday is actually an incredible gift for the future. It's a trap just waiting to be sprung. And that brings us to the number 24. That represents the grueling 24 hours of pure patience required in this specific case study. From spotting that untouched internal liquidity on Thursday morning, the trader had to just sit on their hands, watch the market chop around, and do absolutely nothing for 24 straight hours until Friday's trading session. Honestly, that level of patience is exactly what separates consistently profitable traders from gamblers. It takes immense discipline for sure. When the market is trapped between your two lines, your only action is to wait. Just avoid the noise entirely. It's only when the market phase shifts to actively crossing those lines and grabbing that liquidity that you switch into execution mode. Trust me, a clean chart with just two lines is your absolute best protection against that dangerous consolidation that blows up so many retail accounts. All right, final section. Section 5, the sniper entry. Friday's dramatic execution. So, fast forward to Friday morning. We have our lines drawn, we know exactly where the liquidity is resting from the Thursday, and suddenly, boom, a major news catalyst finally sets the trap in motion. In this specific historical example, a news announcement from Donald Trump hit the wires. Now, regardless of politics, what matters to us here are the pure market mechanics that followed. This news triggered a massive, highly volatile reaction, a stunning 200-point drop in the index in a single 1-minute candle, just a violent flush downward. Now, here's how this strategy executed perfectly, right in the middle of all that chaos. First, that violent 200-point drop deliberately ran straight into Thursday's untouched internal lows, literally the exact line we left plotted 24 hours earlier. Second, as it swept those lows, price perfectly respected the higher timeframe liquidity block. Third, you execute the buy position right there. I know, it feels absolutely terrifying, almost like catching a falling knife, but it's exactly per the system. Fourth, your stop loss goes strictly below the new low. And finally, your target is locked dead on to those external liquidity highs resting far above. But wait, the market isn't quite done trying to trick people. Right after the entry, if you zoom into a 5-minute chart, price actually started pulling back downward. This is super crucial. Beware of false sell-offs. Because our external buy target way up high hadn't been hit yet, that sudden bearish pullback wasn't a reversal at all. It was simply the market inducing late sellers into shorting, trapping them one last time before absolutely ripping to the upside target for a massive win. So, I want to leave you with this final thought. Take a hard look at your own trading. Are you constantly jumping into the middle of the noise, letting the market induce you into acting as liquidity for the big players? Or are you going to keep your charts clean, plot your internal and external liquidity, and wait patiently for those lines to be crossed to take your sniper entry? The choice is totally yours. Thanks so much for joining me on this explainer today, and I really hope this transforms the way you read the charts.